Welcome to Market Matters presented by MyX. I'm Joe Teague. With me is Brian Stutland. How is it going, Brian?
Great. Happy Monday, Joe. Well rested after a 3-day weekend and ready to trade them up and get back into these markets here.
Yeah, welcome to the second quarter. The first quarter was a fantastic quarter, and can we continue this move? We'll wait and see. But I think this rally has gone a long ways. It seems like people are poised for either a big correction or the market to continue higher.
Yeah, it certainly is, and we have a lot on tap, Joe. Right? I mean, we are seeing some big moves in a certain commodity that we're going to talk about today on the show. That's going to really be actually our stock trade of the week will come off of this. But take a look at this chart. This is GLD or gold, actually, I should say. Our trade is on GLD. But gold has really exploded to the upside here. We want to get into why that happens, when that happens, and we're going to talk about more with that, included on our big story of the week here. 5 straight months, up months for the S&P 500. So what that means for the market, what happens 12 months later after that. So stay tuned and watch those two, a trade on GLD and more about the S&P 500 and where that's going.
Yeah, can't wait to get into all that. Real quickly, we'll do the preview. Big story of the week is going to be the jobs report coming on Friday. That will move the market. It will move interest rate expectations. It'll move volatility. We usually think of this as like an earnings report for the economy.
Yeah, obviously, unemployment rate, we're continuing to see that uptick a little bit, Joe. What is it? Up about 0.5% now since its lows. So what does that really mean for the market? I think, the Fed is looking at that. We continue to see a little bit of a rise in unemployment rate. That now gives fuel to the fire for the Fed to cut rates, is which they want to do, not as much as what the market expected. But this will be a big indicator this Friday. We expect volatility to sort of kind of remain skittish, people sort of using options to position themselves ahead of this jobs report.
For me, the thing that's going to derail this market would just be a faltering economy, short of something like a big miss on the headline number. I think the market will be just fine with that. The unemployment rate, ticking up. I think the market's comfortable with that. Hourly wages, it's going to be critical as to how aggressive the Fed can be the rest of the year. Speaking of which, this is our forte, Brian. This is what we look at every day. Of course, the VIX and volatility. We've got a big jump in volatility over just the past week. Why is that normal to you?
Well, yeah, I mean, when you look at the VIX and volatility, we had a 4-day only trading week, right? So we're missing a day. So what happens is option traders will decay the value of options, expecting one less trading day. And so that's reflected in the VIX. Remember, the VIX, the volatility index, is measuring the price of the premium of S&P options. And so if they're taking premium levels down to factor in the weekend, you sort of had this dip in the VIX well below what the futures curve is shaping out to be. Now we're back into a normal week. We've seen the VIX pop, but that's kind of an artificial move. Like I said, we actually, normally this volatility report about the VIX futures curve, we have some sort of indication to help you out on, but hey, it looks pretty normalized here. We're seeing the VIX trade back down to where, probably expectations for movement in the market are at. And we're really seeing a normalized futures curve out. So nothing really interesting to happen. I probably expect the VIX to continue to tick up closer towards that front month VIX future as we get, or maybe the whole curve will just shift higher as we sort of get into this Friday unemployment report.
And that's a great point. The other point to look at it, this chart is, a month ago and 2 months ago, we were expecting volatility in March. We didn't really get that yet. These front month futures are about 50 cents higher, and the market's a lot higher too. So there's just more expectations for volatility right now, even though the market's higher. So that's something interesting to watch. We shouldn't sleep on that.
Yeah, we talked about that when the VIX broke certain levels, right? That volatility would come crashing in. It really hasn't. The VIX futures have remained somewhat elevated, so that's still a little bit of a worry in the market. And
another thing, Brian, we look at constantly, of course, we're looking at the volatility futures. We're also looking at the underlying volatility of the S&P 500. This is one way of measuring the skew, looking at the 25 delta put against the 25 delta call 3 months out in the S&P 500. This is an index that tracks the VIX relatively closely. but it gives us clues. Sometimes the VIX is missing. You look out last October, the market was at a relative low, and people were panic buying these puts. So puts were a lot higher back in October. This actually led the market rally. This peaked before the market bottomed. So this was like a leading indicator. Hey, something's going on here. Somebody knows something. So I expect when the market's at a relative low, this index is going to be at a relative high. When the market's at a relative high, this index is going to be a relative low.
Yeah, I think this is kind of like our, normally we talk about the greed and fear index, but this will be a new little segment. This is kind of our own personal greed and fear index that we like to look at. And that's, how much are people buying put protection insurance on their portfolio versus wanting upside in the market with calls, right? So the lower this value is, the more people want calls to play to the upside. The higher this value difference is, the more people are worried about downside risk in the market. And typically over exuberance happens on both sides of those. So to Joe's point, these puts were very high bid in October. Then the market rallied because people were overpaying for insurance. Now, contrarianly, we're seeing this flattening, people starting to bid up calls and sort of hang in there. So, this could be sort of a leading indicator that the market is a little bit overbought.
Yeah, and one sign that this could be telling us is the FOMO, people buying calls.
Yes.
I don't know if there's any advisors out there watching that have clients calling them saying, hey, NVIDIA's up 300% year over year. How come my portfolio is, only up 20% or, whatever the case may be? People are out there buying calls, kind of chasing this rally. I think, that is kind of a sign. If it is going to turn around, this is going to be where people are chasing it the most, and they're going to be forced to liquidate really quickly if there is a turnaround.
Yeah, good points, Joe. All right, so let's move on to the big story here. We're talking about the S&P.
I got an interesting stat here, Brian. Before we get there, did you know that the market was up in November and December, and it was up in January, and it was up in February, and the market was higher in March? Well, going back in history, these are the times that has happened. That 5-month streak up each of those months. And the year-on-year returns are really staggering. We've only had one negative performance over the 12 months. Full year, no negative performances. An average next 12-month return, right there. That's 15-17% returns, median and average. Looking at full year returns of 20+%. So the numbers are in favor. Seasonality says the bull market is on, and we're going to have a fantastic year.
Well, I mean, we've talked about that artificial intelligence, AI, and that new technology, is it, bubblicious, or is it just getting started? And if we look at 96 or 98, we've said it's probably just getting started, the party right now. And so could we get higher returns in the S&P? My expectations are yes. I am starting to lean longer and longer. Obviously using protection in some of our strategies that we do for clients, because, just worried about, basically options being cheap right now to add insurance to a portfolio kind of makes sense to do a long short trade there to protect portfolios. But to me, the upside looks like it's there for the market.
Yeah, and these are 5 critical months of the year. I mean, every month, of course, is critical for these companies, but of course you have, the Christmas holidays in there. The start of the year is always very important. The Q1 earnings reports have come out. So that's just a sign. This market is on fire month after month, putting up these returns. And it's also, of course, Brian, an election year. Yeah. Man, we're kind of off the charts when it comes to election years. We're having a fantastic start to the year. Usually election years are good. If you look at this, even better with a sitting president election year, you can see this blue area is the non-COVID election years. So we're ahead of that pace, but we're at the time of the year where we see some consolidation. We see, we had a good start to the year, and then we consolidate up until the summer, until the rally will continue.
Yeah, I like how this data actually took out the COVID year as sort of an anomaly on the election year. And then, you look at the sitting president and what it's done. So, yeah, it makes sense. Probably we're in an area of consolidation. I expect the earnings, we're in this new quarter. We're going to get earnings reports coming out in a couple of weeks here and that's been the driver. That was the driver for the market to continue to move higher in the end of January. I expect earnings to be strong too, but does that mean look at that move that we've made so far this year? Does it continue to move higher? I don't know, but at least it supports the market. Maybe we get some back and forth action, for the next 6 months as a sell in May, go away comes here in the second and third quarter. But then look at the back half of the year. Certainly an opportunity to look for getting along the market.
Yeah. So, anyways, let's get on to our big story. We talked about at the start of the year. If this rally is going to fizzle out, it's going to be because the economy falters, and we're going to see that in the employment data, big numbers employment-wise coming later on of this week, of course, Brian. And, if you look at the big chart of unemployment, it doesn't really look like it's done much. We're right there, essentially under 4% where we were, pre-COVID. Obviously. But if you kind of zoom in, and just look narrowly just at the last 6 months, yeah, we are on an uptrend when it comes to unemployment.
Yeah, I mean, that's probably what the Fed is looking at to say, you know what, maybe we can actually cut rates. If this trend continues to move higher, we get a print of, let's say, 4%, then 4.1% or something like that, and the trend continues to be higher off those lows, the Fed is going to be more probably likely to then make those 3 rate cuts that they're talking about. So maybe that's what they're seeing. Anecdotally, although I don't like these like one-off situations, I was just down in Nashville, and I got to tell you, the place was booming. I mean, I don't know if it was spring break or what, but it was packed everywhere. From whatever kind of entertainment you wanted, there were crowds there. And so to me, it seems like the economy is still very strong despite this uptick of unemployment reports. So I think we're going to need a couple more ticks for the Fed to really get it right and want to have to cut rates.
Well, yeah, hot manufacturing numbers this morning too. In spite of which the market is down. The market's down. That must be like an April Fool's joke or something. But all is okay because the the semis are up today at 1%. So, it might just be a little joke for the morning. But yeah, we were talking about earlier on. For me, the non-farms numbers are going to be critical to see the wages, of course. And I actually think, the Fed, in spite of this higher inflation, they're going to cut. They're not going to wait for it to get to 2%. Of course, it is an election year. Maybe that has something to do with it. But they're going to cut. They're going to allow inflation to run hot. That's essentially what the market was saying at the start of the year when they expected 6 cuts. Well, inflation's a little bit hotter than they thought it. The economy is a little bit stronger than they thought at the start of the year. We're down to 3 cuts, but we don't necessarily need any cuts given how hot the economy is, given where unemployment is. But what Powell actually said when he was kind of saying, we're going to cut 3 times, was he said, we don't have the runaway inflation. We don't have higher wages leading to employers saying, hey, I need to raise my prices, which leads to workers having to pay higher prices, which leads them to turn around to their employers and say, hey, I need some higher wages, which becomes this cycle of the employers need to raise prices again, which turns into the runaway inflation. Powell said we don't have that. So if the wage numbers stay in line, I think the market will be fine with that. The Fed will be on pace to cut 3 times this year, and we'll be right on course where we were a week ago.
Yeah, I think that the word runaway is key here, right? Because if we get runaway wage inflation or other inflations, now the Fed will start to lose control of how they control the money supply. And there's nothing more than the Federal Reserve wanting to control the money supply globally for the rest of the world. Like a little inflation is kind of good because it allows us to sort of borrow debt, and then years down the road, that debt, we really borrowed it a lot cheaper because all those other countries that were lending to us, the Asias of the world, China, Japan, and others that do so, their money is worth less. So a little inflation is good. It allows us to borrow at cheaper rates. A lot of inflation is bad because then we start to lose control of that. So I think Paul wanted to see an uptick inflation back a couple of years ago, and they were a little slow to move. And then boom, all of a sudden we got a huge numbers coming out in 21, end of 21 into early 22. And they had to be very aggressive so that we don't lose control of how we move the money supply and control that.
Yeah, it was a decade of like zero inflation. I think China's manufacturing had a big factor to do with that. We kind of stopped. We kind of cut China off. We are not trading as much with them anymore. It looks like we're trying to move that to India. I think it'll take some time to pan out. Anyways, let's bring it on to the big stocks of the week and our big trade of the week. Brian, since the Fed meeting, the best performing sectors are metals, and the top of the top metals is we like to call physical Bitcoin or gold. And look at this chart over the past 4 years here, Brian. It just had trouble at 2100 breaking out. Yes, definitely looks like that classical inverse head and shoulders pattern here, and then just has this really nice breakout here.
Yeah, it does from a technical basis. That range really from where it sort of hit the bottom part of the head to the breakout is, roughly 450 points. So typically, like when we look at price targets, that would sort of give us then the breakout 450 points higher, which maybe takes gold right to that 2,500 mark. It seems like if we look back, I think we have a chart of that, right? Looking back of what happens to gold as the Fed cuts rates. Joe, if you could kind of highlight here, right? 2007, Fed starts to cut rates because of the housing market into 2008. Boom, gold takes off. We saw that again, 2019. Fed holds, kind of dovish. Boom, gold takes off. So when the Fed gets into cutting mode, it's really benefited those gold bugs. The Warren Buffetts of the world don't like owning gold, but there's a place for it. There's an inflation trade to it, or reflation, I should say, almost. And when the Fed becomes very dovish, is in rate cutting mode, it probably makes sense to hold gold in a portfolio. That's what we're trying to figure out right now, how to fit that in for investment advisors that we work with as we set up model portfolios for people. We're thinking about, hey, can we allocate something here to gold? Does it make sense? Does it have more upside?
Yeah, I mean, these runs that it has when it's just on this momentum are phenomenal. Now, there are a lot of volatility. Obviously, this was a lot of volatility here, but it does have tremendous. It is a tremendous momentum trade, and it's essentially a conviction trade for people who are saying we're going to see inflation, and I'm gonna back it up by getting into gold.
Yeah. I mean, so obviously gold is just a metal. There's not really a whole lot of practical uses for it versus other metals, but here it is sort of a measure of what the value of the US dollar is. I know people like to say Bitcoin, and certainly there's been a huge inflows into the ETFs and piling into that. Things put out that, hey, you should own about 5% Bitcoin in the portfolio. But I think Bitcoin has a lot more to it than just a reflation trade. It's got mining capabilities, it's got AI plays, it's got a whole bunch of stuff in there that would affect the price of that relative to gold is really the reflation trade.
Yeah, Bitcoin for me is just a risk on, risk off type of a trade. A lot of technology type trades. Lot more volatile, even though gold is very volatile, but Bitcoin is a lot more volatile even than gold.
Yeah. All right. So I got a trade here. The average person probably is not going to trade gold and hold gold bars stored under their pillow in their house, but you can trade GLD. It's an ETF that tracks gold. And if you look at some of the charts on the technical basis, we talked about this range of where it's been and then the breakout. So that was about a $41 range for GLD and then broke out from there. So if you look at sort of that $200 level to 190-ish, $41 back to the upside, that puts you around the 235, 240 range as in terms of upside technically, where I think gold can make a next stop at. Now, maybe I missed some of this trade. Maybe I missed a little bit of this breakout. I'm going to use options. I'm going to use a call spread, and I'm going to look about 6 months out to give myself some time to work for this trade here. I want to do a call spread. I want to buy a somewhat at the money call, which is in this case the 205 call expiring in September. I'd pay about $11.50 for that. And then since I have a price target here where I think gold can get to and I'm willing to be called away, and that's sort of my level, I can lower the cost of that call I bought by selling the 235 call, the $235 call for $2.50. Net, that's a $9 debit. So break even is 214 on the upside. So as long as GLD gets above there, all the way to 235, I get to profit. So I'm getting about a 2.5 to 1 payout here. I can use some leverage, right? So the other interesting thing about this, the cost of this trade is not that much. It's about 3% or so, 4% of the stock value right now. And that call is already somewhat in the money. So I would actually recommend for myself what I'm looking to do is what I want to do is I want to buy 2 of these call spreads for every, let's say, little bit of gold that I wanted to own. And I can get a little bit of leverage, let's say, to the upside and get twice the bang of my buck. And then if things break down, the Fed doesn't cut rates like everybody expects, gold reverses. I would expect gold to fall tremendously, all maybe back down to the lows that we saw in that trend channel. So this is why a call spread protects me from only outlaying that $9 amount versus holding gold and watching it just fall out of bed.
Yeah, so that effectively is a 2-to-1, better than a 2-to-1 payout. And yeah, so obviously also that $9, it seems expensive, but just buying gold outright, we saw it at 160, a year ago. So just 170 just a half a year ago. So it could move the other way against you, and you're only risking $9. Obviously, that is the other benefit. The other way, doubling it up, of course, increasing that leverage. I think that makes a lot of sense too, because you're pretty confident about the upside. So you don't need to make a home run by it going to like 300. I think you can be a little more calculated, having a better play by having 2 calls on with a targeted price here at 235. By the way, that call of 250 at 235 seems like a nice one to sell, given where the stock is right here.
Yeah, and here's the other thing that we do too. I mean, this is a layout of an option trade, but one thing we do for investment advisors and their clients is we do structured notes. And when we've done those, this would be play into sort of a growth type note where you get some sort of protection. We were just looking at that, let's say about a 10%, 15% downside protection on GLD growth note, and then get a certain participation rate to the upside on that. So the same level of sort of protective play would be an interesting way to do that. You could do that across multiple clients. That's what we've done that for. So that's something that we also will probably be looking to do for people going forward here in these next couple weeks.
Well, all right, Brian, that is going to do it for us today. It was a fantastic show. Great to be here at the start of the quarter. Want to thank everybody for tuning in and following us. Remember, if you're watching live, send us a question, say hi to us, tell us what you're trading. If you're watching on YouTube, like, comment, subscribe, share around the world. Brian, you got anything else to say?
That's it. Tune in next Monday, every 1 p.m. Eastern, just as you're finishing on lunch before you get back to work. Listen to what we have to say. We'll be quick and dirty about everything, get you some good tips on the day. We've been pretty effective in our stock picks and our day trades. So tune in next week, next Monday. We'll see you again.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.